大家好，因为已经10点2分了哈，我想我们还是准时开始我们的 seminar。那么谢谢的一部分的好朋友上一回有参加我们第一次的 webinar，那么是关于 doing business in the US。那么今天的题目嘞，其实我个人觉得是非常非常有兴趣的题目。首先，我们会请Josh Zellerman 来谈一下那个大而美的法案。然后我们今天有另外一位新的 presenter Iris Laws，那么他会跟大家谈一谈最近美国关税的议题，尤其最近美国的最高法院刚刚听证完这样子的案件哈。那么我想对大家应该都会很有帮助的。那么呃，谢谢大家。那我们不耽误过多的时间，那么让我先介绍of course, ladies first. Let me introduce Iris Laws. You wanna say hi and make some self-introduction of yourself, and then we turn to Josh. Go ahead, Iris.
Absolutely. Thank you. And thank you for having me. My name is Iris Laws. I'm a director with our Washington National Tax Office. So focused primarily in tax policy for the firm. And just excited to talk today about tariffs primarily. And, we'll be supporting Josh with some of the big, beautiful bill discussion as well. So thank you for having me.
Okay, thank you, Josh. I know
Yeah,
you
well,
introduced last time yourself,
mhm.
and do it again.
Yeah, no, thank you, Alan.
Yeah.
Thank you, thank you, everyone. Good morning. Again, I presented the doing business in the U.S. as Al referred to. My name is Joshua Zellerman. I'm an international tax partner, and you know, looking forward to talking all things. We call it OB3 and tariffs today. So thank you very much.
Okay, Josh, you have the floor.
All right. I think I can move it. All right. So we're going to go to the agenda, as we said, pretty simple agenda versus our previous presentation when we talked doing business in the US. We're really just going to talk about OB3. That's the sort of acronym we give it here in the US. And then I'll turn it over to Iris to do discussion on tariffs. So you'll see this term, the big three. Okay, this will be the policy or the terminology we use for the big factors that led to sort of this second round of tax reform that came after TCJA in late 2017. And the first one here that's very popular in the U.S. is this act permanently really reinstated 100% bonus depreciation for most tangible property, personal property acquired after January 19th, 2025. And that's an important date because it's really the date President Trump came in the office. So, really putting his stamp of approval on this. Does not obviously, apply if it was property acquired prior to January 20th, 2025. And something we'll get into a little bit later, but there's elections to discuss reduced bonus depreciation percentages. One of the big things that came out of this, President Trump and his administration really have this focus on, really ramping up manufacturing in the U.S. And one of the ways that they're doing that is by really, my understanding, first time ever, is this bonus depreciation for non-residential real property, meaning certain requirements. And really, we'll get into it on the next slide, but the big picture of that is really this property that is really used in manufacturing or refining of tangible property. So, think about creating a new facility for purposes of production. If you meet the requirements, and we'll go through them on the next slide, this is huge because, generally, historically, these would have long depreciation lives, these plants, And currently, being able to expense that in its entirety is, a major deal for some of these companies that would apply for it, and a very attractive sort of incentive to build new manufacturing plants. And it again, similar to the bonus on personal property, tangible personal property, it would apply to, uh, you know, construction started after January 19th, but has a cap on it before January 1st, 2029. And what's unique is one of the things they just basically describe is has to meet this substantial transformation test that's part of our code. That's really only defined in a certain part of our code. It is an international tax provision, but they point to, hey, we kind of view this in the same light as what you're doing to the production line and what's going on.
I think
Go to the
my
next.
favorite example of that, Josh, right, is you're taking
Yep.
pulp and you're turning it into paper, or you have steel and you're turning it into a screw. So it's more than just assembly, right? We're making a
Yep.
meaningful change to the product. And if you're doing that activity, then you could qualify as a manufacturer, which would then allow
Yep.
you to expense immediately your facility. So that's just some background to that.
Yeah, no, thank you very much. That's and kind of getting on that point, um, the 100% sort of the key takeaways here is on the bonus appreciation and qualified production property. So real quick, we talked about those elections. I want to go back to that. It's 100%, but we also have the ability to do a 40 or even 60% as applicable. So that's an important thing to remember, and we'll get into why that matters from a modeling perspective a little later on. But going to the QPP deduction, again, applies to manufacturing, production, and refining facilities. Some things you want to watch out for. Cost segregation is going to be an important thing that we do here. Making sure, are there more assets we could potentially qualify? Again, consider that substantial transformation. And there is a clawback sort of to this, though, 10-year recapture possible for this QPP. So we have to think about M&A implications.
Also, cost segregation is important because
Mhm.
not all of your facility could qualify. So, let's say you have an office or an engineering department or something like that within the building that would not qualify. So, we need to be sure that we're thinking about the whole facility and what would qualify and what wouldn't. And cost segregation studies could help you with that.
Yeah. The next one. Okay. Uh, so what again, the second of the big three we'll discuss is Section 163J. And really what this is our sort of our thin capitalization code section is one of the thin capitalization, but to me, the primary one. And what this really does is for certain, uh, you know, for certain taxpayers that are above what we call our small business exception threshold, um, which is a gross receipts test. There's a limitation currently based on 30% tax basis currently of EBIT. This act will then increase that limitation 30% of tax basis to EBITDA. And that's a big, it's a big deal because what it would do for a lot of taxpayers is it would increase their essentially just taxable income as it relates for calculating this 163J limitation. And simply put, is it would allow for them to take more interest expense in the current year. Some of the things that came out of that though was really reducing or putting this 163J before certain interest capitalization rules. So what some firms were saying is, I'm going to move this interest expense to essentially my COGS or my allocated to my inventory. And instead of that going through 163J, this interest limitation, it was capitalized, but it was being able to be amortized every year. So it was sort of hey, I'm not going to get limited. Yeah, and I have to capitalize it, but I would be able to essentially amortize that, at least some in the current year, and then guaranteed I would be able to amortize a portion of that going forward if I kept running into this thin cap rule. So, sort of, I would say, yeah, you're getting the EBITDA, but also you have to now factor in the fact you can't capitalize this under inventory or cost of goods calculation. And so really what came out of that is you have to order the 163J first before this capitalization. The third of the big three here is section 174, 174A, summary of changes. And I really think this was probably one of the, if not in my opinion, the biggest one. And so it really called for the immediate expensing for domestic R&D cost, the option for immediate expensing of domestic R&D expenses was permanently restored for tax years beginning after December 31st, 2024. A while ago, these rules had sunset. We were able to do it. I don't know what year it sunset. I was thinking a few years ago. But prior to that, they were able to deduct it. Then the R&D rules sunset, and they had to capitalize. Really impacted a lot of taxpayers, especially once in the business of doing a lot of research and development. They have a lot of intangible property. They developed that, so it really did hurt them.
And to be clear, Josh,
Yeah.
sorry, just to clarify, this is just domestic R&D. So it's still the rule that you have to capitalize and amortize foreign R&D.
Right.
So that did not change. This is just US domestic R&D. That's an important sort of distinction.
Yeah. Yeah, and I think, sort of the policy behind that is really having companies focus on having that IP really be developed in the US, right? And having that know-how and not offshoring that. So that 15-year rule stayed. Also definitely continues to be a revenue raiser for them. But yes, you're right, just domestic. All right. And so doing a little bit deeper dive into this key provisions, there was a revenue procedure 2025-28 that was released. And so for that prior year R&D costs from 2022 to 2024, you were able to essentially do a couple of things. One, you could keep amortizing it as such over the remainder of a 5-year period, okay? The second option is you can take all of that capitalized R&D and deduct it immediately, 2025, okay? Or you could deduct half of that in 2025 and the other half in 2026. And again, this is only for the domestic entities, okay? And so, why this is important, okay, is because it allows companies, they have bonus depreciation. They have a better chance of taking interest expense. Now they can deduct all this R&D. It gives them some flexibility. And we'll really, why this is important is because of modeling. There's also international provisions, which we'll talk later on. But all these factors can go in. And if you're having all these deductions in 1 year, it can really limit your ability to take some international benefits, as we'll discuss. Or you could be taking all of these expenses and really generating an NOL or a large NOL that going forward you can only use 80% of in a year if you have taxable income. Whereas you could spread some of this out and maybe not generate an NOL, but still bring your taxable income down to nil. My point in all that is modeling has really become a big, big thing, both these domestic provisions of OB3 and also the international tax provisions, which we'll get into a little later. And in addition to this, there were some other top 10 planning points, compensation and benefits. So payroll reporting, withholding is still required for tips and overtime deduction. But proposed regulations issued listing of qualified occupation and definition of qualified tips. So one of the things that Trump, really announced during his campaign was he was going to eliminate overtime or taxes on overtime and tips. And in a way, they did get this to push through, but there is a mechanism to it, and there is, there is limits to it for employees. But it is considered to still be a very positive thing, and one that we did want to mention for companies that would be interested in coming into the U.S., setting up a subsidiary, and that would, have a nuance or be in this type of industry where, time, really they're in a basically by the hour. They could have the ability as an employee benefit to not get taxed on overtime, essentially using this deduction mechanism. So seen as a very positive thing.
Really, this is just where we're talking to our clients about we need to educate our employees that this is a deduction available. There are some quirky things about how it works, but it's just something to be cognizant of when you're setting up your payroll processes and you're working with your HR department, because there are some requirements that need to be followed.
Yeah, good, great point. Great point. Go to the next slide. So another one that came out, part of the top 10, not necessarily the big three, okay, was charitable contributions. And so really going to focus on the corporate here. But there is a new charitable, 1% floor. So if the charitable giving could be considered advertising, for example, a sponsorship of golf charity, you could explore some of that as marketing. But this 1% floor really comes in and says, hey, if as a company you don't spend 1% of your taxable income, then you don't get a deduction for it. So you need to spend over 1% of your taxable deduction, and that amount over the 1% is deductible up to 10%. So there's a floor and a ceiling, but there is an ability to carry some of this forward with certain rules as well. We'll go on to that to the next slide. Okay, yeah, so, corporations generally allowed to deduct charitable contributions, again, up to that 10%. So the 1% floor starts with tax years beginning after December 31st, 2025. Again, as I said, if contributions are less than 1% of the base, no deduction. If they are between 1 and 10%, basically your deduction is the actual contributions less than the 1% of the contribution base. If contributions exceed 10%, your current year deduction is 9% of those contributions. Or, sorry, your deduction is 9%. Okay. 5-year carry forward for contributions in excess of 10% contribution base, the 1% floor for years in which the 10% limit was exceeded. So that's nice that there is at least a carry forward, although 5 years. You do have the ability to use some of these charitable contributions in a future year. Just be mindful of the interplay between that and NOL as well. So you don't really, make these contributions and then don't have the ability to utilize them.
And this isn't implemented until 2026. So for those trying to plan any charitable contributions by the end of 2025, we're seeing a lot of our clients sort of bunch their contributions. It was sooner rather than later so that they don't fall subject to this. I think from here, I was going to talk a little. Oh, sorry, state conformity. Go ahead, Josh. I apologize.
No worries. One of the big things we're hearing out of this is what are states, what are the state and local tax? As we talked about doing business in the US in the first round, there's a federal tax, there's a state local tax, and then there's a bunch of indirect tax, sales tax, property tax, etc. With a lot of states being underfunded or dealing with political pressure, state budgets, given that this OB3 is considered to be a very still taxpayer favorable bill, it's curious to see what states are going to conform to the state or to the OB3 for state and local tax purposes. So if you recall, Yvonne Chen presented that a lot of states start with federal taxable income. They make state modifications and then they get to a state and local taxable income. Okay. This would be part of those state modifications. So, for example, if they don't conform to the new OB3 rules, there will be a state modification. Okay. That would have to happen to get to the state taxable income. And as Yvonne mentioned in the first call, it's a lot of complexities. Basically, each state is its own country, is how you need to look at it. Sure, it starts with federal taxable income, but there's modifications that take place to get to the state taxable income. So just be mindful that states are still, I think we heard maybe Michigan might be one that put something out on that, Iris. I thought it was Michigan, but maybe I'm
There's a
thinking another.
few. There's a
Yeah.
few states, yeah, but most of them are still considering what to do, and it depends on their budgets and all kinds of different considerations.
Oh, thank you very much. All right.
Great. So I'm going to turn a little bit to clean energy. I think a lot changed with clean energy. And on the US side, a lot of what's been in the media is that clean energy credits are gone. I'm here to tell you that's not true. That's not the case. Certainly some were terminated. So those are the electric vehicle credits, as well as some sort of residential related credits. But that being said, there are still credits available. Most of what changed were related to solar and wind property. There are some restrictions about when you begin construction for those. Then it depends on when you need to place it in service. So if you are considering actually developing and putting wind or solar into service, that would be something you would need to look into. Otherwise, sort of the biggest thing that changed was across the board, whether you're looking at solar, wind, geothermal, any sort of other technology, they put into place what we reference as foreign entity of concern rules. And so basically, if a certain percentage of your property is sourced from these foreign entities, primarily we see in the solar space, China, then you would not be eligible for that credit. And so we're seeing a lot of strategies about where are we sourcing some of these components for our property. There's some rules about how you're structuring your debt, how your own business is owned, cannot be related to these foreign entities or these foreign countries. And so that's really something to look into. The ability to sell and buy clean energy credits did not change, however. So that's an interesting thing that survived the act. This slide a little bit is just talking about further those beginning of construction rules that apply to solar and wind. It was an executive order that President Trump put out to try to restrict even further how someone can qualify to claim those solar and wind credits. I won't get into the details today, but again, if you're interested in putting those in place, please reach out. Oh, you're muted, Josh.
Sorry. I will wrap up the OB3 with the international provisions. This is in my wheelhouse for sure. So one of the ones, we talked about inbound when we did doing business in the US. We talked about inbound companies coming into North America. And what I see generally is the US is a good sort of launching pad for that. Okay. So this would be a scenario where you would create a US subsidiary, but would maybe have foreign subsidiaries underneath the US subsidiary, generally Canada, Latin America, South America, Mexico, etc. We see the US as a good launching pad for that. One, just because of the market, but two, the strong corporate rules. So when the market avails itself, companies will then sort of increase their global footprint in North America. through Latin America, South America, etc. So one of the things is if you're a U.S. subsidiary and you've got controlled foreign companies, as we discussed a little bit in doing business in the U.S., permanently extended, what we like to call in the U.S. is look through, and really, to get not dig too deep into this, but for our controlled foreign corporations, we generally, if they're an active foreign subsidiary, okay, they have what we call sort of a minimum tax mechanism that we refer to as GILTI, which we'll talk about now, is called necktie, which is the acronym for it. But if these CFCs are active, there's also a passive passive income mechanism that is taxed, and that's taxed at 21%. So this look-through rule would say, hey, if there's interest or dividends between these active CFCs, we're going to consider those what would normally be passive, types of income under our subpart F would not be subpart F. So very seen as a very good transactional extension of this code section that we as in the international tax community, we're hoping it would get permanently extended. Another big one that came down was a restored or no downward attribution. And this was important for foreign companies that were inbound parents of a U.S. subsidiary. And generally what this rule would say is, if you're a U.S. company, but you've got brother, sister, foreign subsidiaries, we're going to assume that this downward attribution took place, whereas you were in control of those other foreign subsidiaries. It was immediately not well received, as you can imagine, created a bunch of additional compliance. And in reality, if there was no U.S. shareholder above those other brother, sister foreign companies indirectly, let's say through maybe a private equity investment, or another, I've seen it in a public shareholder had a 10% interest, and it created an issue for another company indirectly. There was really no taxable income consequences. So it was a lot of extra compliance, just because of this rule, without really being much of a revenue raiser to me for the Treasury. So getting rid of this was considered a very positive thing. There is a little nuance to it in that situation where you have a U.S. person who's a minority interest in a foreign subsidiary along with a foreign parent. But just be mindful of, if you use your U.S. subsidiary to have minority investments and you're a foreign inbound parent, please reach out, because there could still be tax consequences. The other thing was that we had this repeal, this 1 month deferral, really more of a compliance nuance in there, but still worth noting that if you have a foreign subsidiary of a U.S. company, and that U.S. company, I believe, has to be the majority shareholder, I want to say it's 80%, that you have to follow that U.S. shareholder's tax year in terms of books and records. Another one here was really big CFC change. This is we go from GILTI, as I discussed on the first call, and we're renaming that to net CFC tested income. So they are sort of the same mechanism, but the mechanical formula has changed along with the name. So we're going from the acronym GILTI to NCTI, or necktie. So we're calling it here in the US. But really, one of the big things that came out of that is they removed this deemed tangible income return, or DTIR. And in many ways, that would reduce your GILTI previously, or your future necktie. But you also had to do sort of a separate set of depreciation schedules. So some people applauded it, some people didn't. I think most people are happy they don't have to do this alternative depreciation calculation, even though this was considered a reduction to this minimum tax. Next point there, the international provisions modify the pro rata share rules for CFC inclusions, to consider CFC inclusions for subpart F and necktie based on the time period of CFC ownership rather than the ownership on the last day of the year. So, really kind of the big picture is previously, if you were a US shareholder and you sold a CFC to another US shareholder, it was really that US shareholder's determination to pick up GILTI if it held that stock on the last day of the year. There were some nuances to that calculation for the seller, but really the purchaser of that, if they own that controlled foreign corporation and they owned it on the last day of the year, were responsible for picking up what was GILTI, now will be necktie. So we've kind of taken a step back and said, hey, it's really going to be more of a pro rata share. If you owned it and it was controlled half of the year, you'll have to allocate necktie for the period that you owned it. Same with the buyer in that situation. I haven't really heard whether or not clients, I think this is going to be more of a problem for middle market clients who seem to have a lot more M&A activity as it relates to this, especially if they're not in a traditional C Corp structure, they're in a flow through structure. I think that's where it's going to be a headache. But currently it is this rule has been modified and something that to consider when investing or doing business in the US. All right. So really, I think very positive adjustment that came out is the Section 250 deduction. This really is our export incentive. So if you create a US subsidiary, as I mentioned, in doing business in the US, and that you want to manufacture, take advantage of maybe the bonus depreciation, et cetera, and now you're exporting to customers in Canada, Mexico, South America, you would qualify even as a foreign parent if you own that US subsidiary and they're producing and exporting to a foreign customer, a non-related foreign customer for foreign use, you get an export benefit. And previously it was called FDII, foreign derived intangible income. Now and as part of that, you had, again, this deemed tangible income return, whereas it was a positive thing for the GILTI. This was a negative thing because it would reduce your export incentive. As with GILTI, they removed that. So this is one where it was almost dually applauded because now you didn't have to track assets under this alternative depreciation system. But hey, you're also increasing your ability to increase this export incentive. So that is one favorable aspect. Also, again, the act changed the name from FDII would be renamed Foreign Derived Deduction Eligible Income. Really the same purpose and point, although the calculation mechanism has changed. Unfavorably, the act reduced the Section 250 deduction for FDII from 37.5% to 33.34%. Okay, so your effective taxable rate on that income is going to be slightly higher. The same with the 250 deduction on your GILTI or necktie. Previously, it was 10.5% because you would get, which is half of 21%. So it went, that 50% now is going to 40%. So it won't quite be half of 21%. It'll be slightly more. I'm not going to do the math on that right now, but point is, this is considered, wasn't really, got rid of the DTIR, but they also reduced your essentially deduction percentage. This is a deduction mechanism for both of them. One of the other big points here is previously you were allowed to pick up any gain or sale disposition of intangible or tangible property. Now they're saying to meet this FDDEI, you have to exclude any gain from the sale of disposition of intangible property and the sale of depreciable property arising after June 16th, 2025. So if you have, it's going to be a tracking mechanism that you'll have to work if you have U.S. Subsidiary that is producing and exporting, and it does have sales or dispositions just be mindful of those dates. Another positive thing is, as part of the previous FDII deduction, now FDDEI, it was apportioned interest and R&D were applied to that calculation mechanism to essentially reduce your the amount of the export incentive. They removed that and said, really, we're only going to apportion directly allocable expenses to this foreign derived deduction eligible income. This is considered a very positive thing, should raise your ability to take this export incentive. All right. Quickly going through, the foreign tax credits. There was a haircut on your necktie or GILTI taxes. The ability, you would gross up the full amount, but of that gross up, you were only able to take 80% as a foreign tax credit on that minimum tax that we call GILTI, now necktie. They increased that to 90%, favorable thing. However, any distributions or withholding tax out of that will also be haircut now to 20%, whereas previously they weren't. So just be mindful of there are modifications to this, specifically GILTI, now necktie, foreign tax credits that were impacted as part of this OB3 package. So there are one other point here, sourcing rules is prior to TCJA really looked to source production as it relates to our foreign tax credit to the country it was produced. This was not seen as a positive thing, and there was a little pushback in a situation where you have a U.S. subsidiary or a U.S. company that has a foreign branch, foreign disregarded entity that they use to distribute, let's say, inventory. Previously, that would all be sourced for foreign tax credit purposes as U.S. source income. Now they're saying, hey, you get to source 50% of that to the U.S. Basket, the other 50% to your foreign branch basket. Considered a positive thing for the ability to help with your foreign tax credit here in the U.S. Essentially, we're shifting that to what we call foreign source income, which helps your ability to take foreign tax credits as it relates to that category of income. And BEAT, the 2026, so BEAT is very important for foreign parents of U.S. subsidiaries. The 2026 provisions that would have eliminated the ability to take certain credits, specifically R&D, against your BEAT tax liability were repealed in their entirety. So very good thing. A lot of taxpayers, their regular tax due was going to be lower than their BEAT tax liability because of these sunsets. So now it should level the playing field a little bit, and they should not be exposed. At least that is the theory. Still something to calculate. Also, the BEAT tax rate did increase as part of a revenue raiser from 10% to 10.5% for tax years after 2025. And we're not going to go through the 163 changes. Previously, there was a CFC grouping election to help boost your adjusted taxable income for 163J. Given that we're on an EBITDA approach to it, this was sort of one of the things they did correct and said, hey, you're not able to do this. We're giving you enough ability to increase your limitation, I think is probably the theory behind it. But just note that any minimum tax picked up as part of GILTI or necktie will no longer be included as part of that calculation. All right, I'll turn it over to Iris.
Great. So in the interest of time, I might jump around for my slides a little bit. So apologies to Valentine, who's sort of working the slides. But in the interest of time, I'll focus first on sort of a high level of why President Trump and his administration is taking the approach that they are on tariffs. So we think that this is sort of a three-pronged approach. The first reason that he gives for this first trade, America First trade policy, as he calls it, is to raise revenue. So with American debt and deficits in the trillions, there's been this trend towards focusing on raising revenue, whether it be through OB3, as Josh was talking about, or this tariff policy. So the second would be increasing investment in US manufacturing. Josh also talked about that with OB3, right? So the administration has gone so far to use the dependence on international manufacturers as the basis for declaring a national emergency. And so that national emergency is what President Trump used when he implemented the reciprocal tariffs under IEEPA, which is what is under the Supreme Court hearing that we will talk about here in a minute. So that's the second prong. The third is that he's using it to leverage, using it as leverage to reduce trade barriers. And so he views things like digital service taxes, VAT, that kind of thing, as unfair trade policies. And so he's using the tariffs to try to keep those policies from being implemented. But if you step back, right, he's trying to negotiate as well. He's using it as a negotiation tactic. He's been, actually fairly successful, all things considered. Recently he had some trade frameworks put in place for countries like Vietnam, Malaysia, I think Cambodia was one of the ones with the frameworks. He had some agreements with Japan, South Korea, right? Back in July, he had the deal with the European Union. So sort of as a backdrop, it's just all of this negotiation that's going on and continues to go on. And that kind of pairs well with his tax policy, right? So that overlap between the focus on US manufacturing. As Josh mentioned, a lot of what was put into OB3 was made permanent as a prior rule, right? So he's trying to provide that consistency so people can estimate and provide projections. And then he's also trying to limit the need to increase taxes, tax rates. That's still to be seen. There is some discussion that there might be another reconciliation package, another tax bill where increases might be considered. There was something called the millionaire's tax that didn't get into OB3. It could be implemented. We don't know. And the second tax bill really is dependent on the political capital that the party in power would be able to wield in order to get something like that through. So I'm actually going to pause here and just let me see. Valentine, could you go to slide 33 for me? Is that possible? I'm going to switch real quick to the case because I think that's probably of interest to everybody. And then if we have time, we will go back to some of the tariff strategies and background and all of that. So right now, as I'm sure all of you know, there is a case at the Supreme Court of the United States to overturn the reciprocal tariffs that were put in place by President Trump. So reciprocal tariffs are basically tariffs that are put in place to balance out where there might be a trade deficit or sort of an unfair balance of power when it comes to trade. Liberation Day is what he called it. It's when he announced those tariffs. It was like the big old chart with all the different countries, right? And it was done under IEEPA. It's one of the acts, many acts that the president has historically used to implement tariffs. So it's interesting. What has happened is that it's gone through two lower courts, the Court of International Trade and the CAFC, which is our appeals court. And both of them decided that the tariffs should be overturned. Now, they said they got to that agreement for different reasons. The Court of International Trade mostly argued that it was going to be unconstitutional. What's interesting about that is that there were 3 judges in the Court of International Trade. It was a unanimous decision. They all agreed. And those 3 judges were actually appointed by presidents of different political parties. So it was seen as sort of a bipartisan decision, which could, be an indication of how the Supreme Court rules. The next court, the appeals court, also decided that they should overturn the IEEPA tariffs, but they looked more to the specific language of what was in IEEPA as to say whether they should or should not allow the tariffs to go through. That was a split decision, so it was 7-4, and there were 2 sort of opinions in the majority that agreed with it. The first was that the language within IEEPA says that the president has the power to regulate trade, but it does not specifically say that he can tariff or tax. And so because of that, they sort of ruled, hey, you can't use IEEPA as those tariffs. So if we go to the next slide, this is the language that they were looking at. At the Supreme Court, which has now had their hearing November 5th, they had their hearing and both sides were heard. And it's probably going to take about 2 to 4 months just looking at recent cases before we even hear what the decision is going to be. But this first point is the language that they're pointing at. The government, President Trump's defense, is saying, as part, even though this doesn't say specifically that taxes are in there, it does say that the president has the power to regulate trade. So we're arguing that that means tariffs. What the Supreme Court, the plaintiffs were arguing is that, well, the president does have all these different powers, but that does not include the power to raise revenue or tariff. And so that's the argument there. Next, the government did say that the president has the power to and the duty to be in charge of foreign affairs, and so he should not be held to the same standard, that constitutional standard, that some of the other parties that play would be. If we go to the next slide. This talks a little bit more about the constitutional argument. So in the United States, Congress has the ultimate power to implement tariffs and to set tariff rates. However, they are able to delegate that power to the president or to another party as long as there are sufficient checks and balances, restrictions to that. So they can't just give it away fully without any restrictions. That's the argument that's being made, is that what President Trump has done and is that with IEEPA is that there's no sufficient restrictions, and so that does not meet the non-delegation doctrine that is talked about on this slide. So if we step back, what does all of this mean? At the end of the day, if the Supreme Court decides to overturn IEEPA, that would mean that it's possible they would require all of the tariffs to be refunded. So even though the 2 lower courts did rule to overturn it, they issued a stay, meaning that the government has still been levying those tariffs, even though those lower courts ruled that way. They were saying, we're going to keep it implemented until the Supreme Court gives their decision. And so it's possible that if the Supreme Court does not agree with the government and says we're going to overturn it, that they would provide a refund for all of those tariffs. However, in the Supreme Court hearing, it was proposed that the tariffs actually only not be refunded, but they would not be levied on a prospective basis, so moving forward. So that's possible as well. So if I'm sitting in your shoes, what should you be thinking about? You're probably trying to avoid having to pay a tariff until you hear from that Supreme Court, right? And so there's something called an entry liquidation, which ultimately is the final calculation of that tariff. You can file an extension to keep from having that liquidation occur, that final levy of your tariff. That it's an extension for about 3 years maximum. And so if you were to file that extension, you would be able to then avoid the process of paying the tariff, filing for the refund, waiting for your cash, or in the other instance, right, paying the tariff and then they don't issue refunds even though they overturn the IEEPA tariff. So something that we have seen as a trend is that President Trump has been issuing recent tariffs under Section 232, which is another section that tariffs are traditionally implemented under. So the recent one was furniture and lumber was under 232. He's been doing that. So I don't know if that's an indication of if he thinks his case will be successful or not. But we are seeing him continue to issue tariffs just under 232 instead of IEEPA, sort of to keep that ground. So I can talk further about some tariff strategies and some background of tariffs, but Al, I promised you at least 5 minutes of questions. I can pause now for some questions, and then if we don't have them, I can talk a little bit more about maybe some tariff strategies to think about if those are impacting you. Does that work?
Uh, Iris, why don't you finish the strategy part and then we open up for questions?
Okay. All
Okay.
right. I will try to get through those. Why don't we go, Valentine, to slide 30 if you could, and I can talk through some of those. Sorry, one more back. Perfect. So there's a number of strategies that we talk with our clients about if you are impacted by tariffs. The first is tariff engineering. And so that's really where you're thinking about where am I manufacturing my end product versus where am I maybe manufacturing my components. So it might be beneficial to manufacture components in a high tariff country, import them, and then finish assembly in the United States or finish final manufacturing in the United States. That's you want to think about where substantial transformation happens. That same topic that Josh covered earlier. Something that our clients have been doing is in negotiation with their vendors, because of the nature of what's happening right now, right? A lot of the vendors are making way for negotiations in their contracts to cover part of the tariffs or lower their prices. So we are seeing some flexibility from importers and vendors to make those negotiations in their contracts. So something to think about. Transfer pricing occurs when you have an intercompany transaction. There is a window that's allowable, sort of a range that is allowable to price your goods when you have a related party transaction. And there's different methods that you can use for this that would then let you take the lower end of that range. And so we have a whole service offering that's focused on transfer pricing for this kind of thing. When we think about timing, this doesn't lower your tariff, but it does help you delay the payment of the tariff, right? So bonded warehouses is something, if you were to import into the United States, you could sort of park your goods in a bonded warehouse and you don't owe the tariff until it leaves the bonded warehouse. So, you were waiting for the Supreme Court to give their ruling. Perhaps you put it in a bonded warehouse, you try to wait it out the 2 to 4 months until we hear what's going to happen, and then you would release from the bonded warehouse and either pay a tariff at that point if it's due or not. When we talk about duty drawbacks, that's where if you were to import a good and then let's say you ultimately have to destroy the good or you export it back out of the US, you would be able to have a refund or a duty drawback of the amount that you paid. Classification is an interesting one. So in the slides, which you'll have access to, we talk about classification being how we categorize certain goods. There's some strategy that can be in play there because how a good is classified is an important determinant for how much tariff you will pay. And so my favorite example, you have a tennis shoe that is a relatively higher tariff rate, and then you have a slipper. It's possible that you add some felt to your tennis shoe, and now it can be classified as a slipper at a lower rate. So there's some games that can be played there. Unbundling. So there are certain costs that should be included in your valuation that the tariff is based on. But there are certain services and other things that can be taken out of that total price to get the valuation lower and lower your tariff rate. So that's things like warranties, freight costs, some other things that are listed in your slides and in a few of your later slides you can look at. So that's a consideration as well. And the last, of course, is thinking about your supply chain. So is it the right time to consider a new vendor? Is it the right time to consider setting up a new plant or utilizing a plant in another country? That's certainly some of the conversations that we've been having as well. So those are sort of my highlights. With 3 minutes left, do we have any questions we can touch on?
Okay, I think Valentine already opened up the chat so that anyone can raise the question right now.
I have a question.
Great.
I'll go ahead and ask. What I've seen so far, Iris, in a related party context, your U.S. subsidiary with a foreign related party, seen transfer pricing sort of be that first main mechanism. Is that what you're seeing as well?
Absolutely. And I think that that's the one that has been it's most easy to understand. It has a lot of history as to some of the transactions and methods that work and don't work. Some cases that we can point to of how the IRS or the Border Patrol sort of feels about certain methods. So I would say that that's a fair assessment to some of these strategies. Yeah.
Yeah, and it's an interesting. Oh, go ahead.
Oh, no, yeah, for sure. No, I was just going to say, something for Taiwan specifically, right? You want to be very aware of what act or rule that the tariff falls under. So if it's not IEEPA, is it a 232 tariff, which is specific to certain goods, right? So that's steel, aluminum, auto parts, some things like that. Those stack on top of other tariffs. So that would be your standard most favored nation standard tariff that's in place, regardless of a treaty kind of thing. Is it a Section 301 tariff, which the biggest example, of course, right now, right, is the one for China. Those are those country specific tariffs that are in place to quote protect national security from a U.S. perspective.
Yeah, Iris,
go ahead.
Sorry,
Yeah.
sorry. I thought I saw a first sale rule, and I know one client asked me about first sale rule. You want to briefly touch on that?
Of course. So the first sale rule is also a great strategy. I think it's best explained with an example. So you have a manufacturer, you have an intermediary, third party, think like a distributor, and then the importer in the United States. Traditionally, the price that the third party middleman pays the manufacturer is going to be lower than the price that the U.S. importer pays that third party middleman. And so what first sale rule allows you to do is to look through to the price that the middleman pays the manufacturer rather than the price that you pay the middleman. So it gives you that look through lower first sale price. There are certain requirements that you need to meet there. It needs to be intended for the U.S. initially. The middleman and the manufacturer need to be unrelated. It needs to be at an arm's length. So there are some considerations, but that's a great point, Al, for sure.
Got it. I thought I saw someone, but I couldn't actually see the question. Valentine, do you see that question?
Yes. So
Okay, go ahead.
Mr. or Miss Wu is asking if I am engaged in cross-border e-commerce through Amazon and my products are already manufactured goods exported to the US via FBA, could you share some methods I can use to reduce taxes or pay less custom duties, or how should I handle the transfer pricing?
That's a great question, and I could go on for a while probably. So, we are at time. However, we have a wonderful transfer pricing group that I would love to connect you with. Al, if I could get this person's contact, I would love to
Sure.
connect them with our transfer pricing group so that they can talk about that. And I think that would be a great first step for that.
Okay, so Mr. Wu, we'll get your question. I'm pretty sure we have your email. We'll have someone contact you with respect to your question. Okay, any other questions? Josh, I have one question for you. I think
Sure.
this probably the last one. We've seen a lot of US headquarter. It could be foreign owned, it could be US owned. Foreign headquarter subcontract its R&D activities to Taiwan, to other countries, programmer to write codes, so on and so forth. And there is a cost plus arrangement between foreign sub to the US headquarter.
Mhm.
Expensing is happening in the US. Are those R&D expenses considered domestic? Go back to your immediate expensing rule.
So that's an interesting question. If we're contract R&D,
Right.
does the R&D get capitalized, or are you able to expense that immediately? Al, I don't actually know the answer to that off the top of my head, but my guess is if it's at third party or arm's length, there could be potential for you to deduct that going forward immediately. But I think you've got to be careful if it is in fact a related party.
Usually related party.
Yeah, usually, my gut is telling me that it would still fall back to the 15-year amortization period on those costs, because it would probably look through to say who's doing who's doing the R&D. Now the question is who's owning the IP, right? The US is owning the IP, and they contract that out, the research. Okay. That's where it could be a little bit of a gray area. And I honestly don't, it's a great question. Don't know off the top of my head.
It's okay.
But my guess is in that context, probably going to be more of a harsher lens to where they would probably still require you, because it's not US people doing the work, right? And that's the whole purpose. That it probably could still fall under the 15-year amortization. Iris, do you have any insight into that? Have you run across that?
I don't. I play more on the federal side of things, so
Yeah.
I defer to your judgment on that one. But
Yeah.
we could also confirm with
Yeah.
Mike on that one for
Yeah,
sure.
and we've got a tax specialty. I'm an international tax specialty. Our federal tax specialty group that does R&D would probably know the answer to that question
Okay.
now, so we
All
could
right.
share that.
Yeah, not a problem, because I'm thinking some of these high-tech companies, if they're going to do manufacturing in the US, usually they're still going to the US manufacturing side is going to rely on a lot of work, either done in Taiwan, R&D, development, so on and so forth. So whether the US manufacturing side may be owned by Taiwanese, either listed company, private companies, whether, the US manufacturing side can immediate, expense those. I think it would be crucial.
The question is, the question is if the foreign parent maintains the IP and they're charging. Yeah, if that's the case, then I think that's more of a transfer pricing. I call that more of a management fee overall. And that's usually immediately deductible in the US side of things, where, hey, I've got a foreign parent, they're taking on certain risk, researching IP. We're really just producing in the US. If that's the case, they charge that cost plus, sort of management, technical, et cetera, know-how. That's usually expensed immediately, assuming it's at their, arm's length, or
Okay.
if they were,
Yeah.
in fact, a third party.
Yeah.
Um,
So the same rule applies to the foreign sourcing rule, if I may.
yeah, that's another way to look at it.
Yeah. Yeah. Okay. We we passed the ending time for this. I want to thank Iris. I want to thank Josh for your second time to join the webinar. It has been very, very insightful. We will put the presentation on our archive and put it on our website. So we'll notify our registrants if they have further questions. We'll be in touch. And thank you very much. I know it's getting late in the States, so you guys have a great night. Thank you very much.
Thank you so
Thank
much.
you so
It was
much, Al.
nice to
thank
be
you.
here.
Yeah,
Yeah, thank you, everyone.
All right. Thank
Bye.
you. Bye-bye.